Thank you, and good morning to everyone. It's great to be here, and I hope you find my presentation over the next few minutes to be quite interesting. So if we could review a little bit about what I'm going to talk about, I thought it'd be good to reflect on, what is a board's primary duties, responsibilities, and what are some of the limitations that they face? So we're going to spend a little bit of time talking about that, and also the nature of boards, because there's a big various difference between how various boards operate in different entities. Then we're going to talk a little bit about, well, how's all this come into play relative to digital transformation initiatives, which certainly is a very hot topic at the board level, as well as throughout most organizations today, particularly in light of how the pandemic has accelerated a lot of focus and efforts to digitally transform their businesses. And then how can a board really add value to the digital transformation initiatives? What can they do to support the CEO and the organization in order to make those happen? So why was I asked to speak on this subject? What sort of credentials do I have to have the ability to do this? Well, I've been on the board of directors of a number of several public companies and a number of private companies. I actually co-founded and grew a company called Captiva Software Corporation that was in the information capture area, and we sold that to EMC in 2005. After that, I was actually on the board of a number of companies that all of which also, like Captiva, ended up getting sold to a larger consolidator or acquirer. So Guidance Software, which was in the security space, I was on the board of that for a number of years, where we effected a lot of change and eventually sold it to OpenText. Also on the board of a company called iOmega, if you remember them, that was in a lot of the desktop storage area, which we also transformed and eventually sold to EMC. And a little company called iMany that was in the contract management software space that, again, we transformed significantly and eventually sold it to a private equity firm called LLR Partners. Currently, I'm not only on the board of Kofax, which I joined in 2007 and affected a lot of very significant transformation. We sold that to an MFD, a multifunction device manufacturer called Lexmark, in 2015. And they asked me and my executive management team to step up and run their broader total enterprise software business, which we did, and affected a lot of transformation then. Only to have Lexmark decide to sell itself, and the eventual acquirer decided that they had no interest in the software business that I was running, and we carved that out and sold it to a very large private equity firm called Thoma Bravo in 2017 that only invests in enterprise software businesses and has been a great financial sponsor for the company. In addition to being on the board of Kofax these days, I'm also on the board of directors of a large, about $4 billion plus a year revenue company called Diebold Nixdorf. We'll talk a little bit about them and some of the transformational efforts they're going through at the current time later in the presentation. I've also been named a Director of the Year by the Corporate Directors Forum, which is quite an honor to receive. So you add all this together, I have quite a bit of experience, not only operating as the CEO of private and public companies, but also serving on the boards of other companies and going through a lot of change in all the businesses I've ever been involved in. So what are the board's primary duties and responsibilities? We really ought to start with the fact that they have a fiduciary responsibility to protect the interest of a company's stakeholders. And stakeholders is a pretty broad description for everyone who has a stake in the ongoing success of the enterprise. Certainly, it includes the shareholders, and you certainly have a primary responsibility to them, but I think you also have a responsibility to the employees, to your vendors, to your customers, and everyone else that are part of what you may think about as your ecosystem and the chain of organizations that you have to interact with on a daily basis. In addition to that, the board has to maintain an effective system of corporate governance at the board level. That's certainly not their role to go down into the organization and start fiddling around with how the business is run or what sort of process, policy, procedure, or management structure ought to be put in place. They also need to determine the company's mission and vision. What is the company going to be? What's it aspiring to realize? And what are we going to use to measure the success of that effort? And all three of those are very important to take into account when you come to what I think is the single most important responsibility that the board has, and that's to select or hire the CEO. If there's anything that transcends all the responsibilities on this page, it certainly is selecting the CEO. And if warranted, for whatever reason, after selecting them, then they need to terminate his or her employment. That's the primary responsibility of the board, to protect the interest of the company stakeholders. The CEO has to run the company. To maintain an effective system of corporate governance, the CEO has to be aware of how the company is going to be run at the board level. And certainly in order to operate the company and execute on its mission and vision, he has to understand how the board views that. So once they select the CEO, they've also got to provide a lot of advice, counsel, and support to the CEO and collaborate with the CEO on a regular basis in order to ensure alignment with one another. They need to also review the CEO's performance over time to ensure that, in fact, that he or she is not only striving to achieve the mission and the vision, but is also being successful in those efforts, where challenges may exist and what sort of value they might be able to add to help the CEO in actually achieving the goals and objectives. They also need to ensure that there's a sufficient strategic and operational planning process put in place by the CEO throughout the organization, because clearly one of the things that the board also has to do is review that annual operating plan and approve it from a fiduciary responsibility. And then, of course, let's not forget that the board isn't immune from evaluating its own performance, and that's a necessary part of what it needs to do. So their job is not, and I think the number one thing to take away from this slide, their job is not to jump in and tell the CEO how to run the business, or jump in and bypass the CEO and talk to his direct reports and attempt to tell them what they should be doing. It's really to set an overall high level of the company's mission and vision, goals and objectives, put a governance system in place to ensure that the CEO is pursuing those, and then to collaborate with the CEO on a go-forward basis in order to assure that they are doing their best to actually achieve those defined goals and objectives. Now, one of the things you find when you look at boards is there's a variety of ways in which boards operate. And this may seem strange based upon the fact that their primary duties, responsibilities, and limitations are basically the same, but boards have different personalities. They have different types of directors. A lot of boards that have served for a long period of time have a tendency to become more passive. And simply stand back and approve what's brought to them, as opposed to actually engaging in a productive conversation about what really needs to be done and whether or not the proposed plan is going to achieve those objectives. On the other hand, it can go all the way over to the right-hand side of this slide to the most involved type, where you have what you might refer to as an operating board. And these are the folks that feel they actually need to roll their sleeves up, jump in, and help the CEO run the business. And they actually attempt to try to get involved in making a lot of key decisions that the CEO should actually be making in collaboration with his executive management team, rather than them actually jumping in and doing it on his behalf. And so there's a broad expanse of the way in which boards operate. I think from my perspective and all the boards I've ever operated on, it's been in the middle there, what's referred to as the engaged board. So what's that engaged board look like, and what does it actually do? We got to go back a slide here. Sorry. So the engaged board actually does what I think is the most productive level of engagement with the CEO. So it works with the CEO in a very engaged and productive manner in order to collaborate and understand what direction the CEO wants to take the business, and then to be able to agree on that and support the efforts of the CEO in executing that. So if you look at these 5 points that are made here, primarily their responsibilities as an engaged board are that they want to help the CEO by providing insight based upon their prior experience with the company, provide advice and also support to the CEO. The CEO is often a lonely figure. He has a huge amount of responsibility and he needs the support of his board in order to have the level of confidence necessary to move forward with the initiatives that they agree on and want to execute. Secondly, the board needs to recognize that its ultimate responsibility is to oversee the CEO and the company performance, not to make it happen, not to manage it, but rather to provide oversight and a little bit of guidance and collaboration with the CEO in order to improve the probability of them achieving their defined goals and objectives. Third is they need to conduct useful two-way discussions about key decisions facing the company. So the board listens to the CEO, they have an opportunity to question some of the assumptions or some of the things that he wants to do and come to a common ground and a collaborative go-forward basis. They also need to seek out sufficient industry and financial expertise to add value to these decisions that are being made. So in many cases, you'll see boards going out and asking for advice and counsel from a variety of potential advisors that can be financial, can be IT, can be any sort that can bring and add value to the decisions that they're making in conjunction with the CEO. And then, of course, the board also needs to define the roles and behaviors that are required in order to set boundaries by the CEO and what the CEO is going to do and what the board is going to do to have very clear lines so they're not in conflict with one another. Now, it's interesting, when I first joined Kofax, one of the things that I found that was unique and I had not experienced before and haven't actually experienced since then is that the board actually had a list of what they called matters reserved to the board. So it was a relatively short list. I believe it was between 10 and 12 specific things that required board approval in order to be executed. And it provided a very clear definition of that so that there was no confusion between what the board's responsibility was in providing the sort of oversight that they're charged with and what the CEO is charged with executing on in actually running the company on a daily basis. So, how can a board add value to digital transformation initiatives? Well, I want to talk about 2 examples here. This first one is Wells Fargo. Wells Fargo, I'm sure everybody knows who they are, a very large bank here in the United States. They've been a customer of Kofax's for well over a decade. They have used our legacy products for years. They have it installed and are using it across every single line of business that they conduct. So commercial lending, personal lending, leasing efforts, private wealth management, savings and checking and investment account openings, and virtually every line of business that they're involved in. And so we have had a very deep level of engagement and involvement with them over the years. But here more recently, in February of 2020, after a lot of conflict with the U.S. government, as well as a lot of debate inside Wells Fargo, they finally entered into agreements with the Department of Justice and the Securities and Exchange Commission to resolve the investigations that the government had instigated into its sales practices, particularly during the 2008, 2009 and subsequent period, in terms of attempting to open accounts and improve their business, but some of them being of questionable ethics. And they finally resolved this by paying $3 billion in penalties. Now, there were no specific directions on the part of the Department of Justice and the Securities and Exchange Commission as to what they were to do to improve their processes. But after doing this, they immediately embarked on what we'd all consider to be very significant digital transformation efforts to improve their internal controls, regulatory compliance, and the overall customer experience that they were providing to potential customers and to their existing customers in order to deal with all these challenges that they had unfortunately failed in the past. All that was driven by the new CEO that was brought in about 1.5 to 2 years ago. And he collaborated with the board in order to obtain its advice, counsel, and support to do this in order to rectify the challenges that they had experienced in the past. And despite all the well-intentioned efforts that had previously been executed upon, but hadn't been particularly successful, he finally wanted to put, a nail in this in order to say it's done. And we've done everything that we need to do as an organization in order to go forward with a clear conscience and with the best practices in place in order to provide the highest level of service and experience to our customers and not run afoul of any of the rules and regulations that we have to deal with on a regular basis. So as part of these efforts, recently during Q4 of 2020, Wells Fargo, as part of this effort, made a decision that they were going to upgrade from our older legacy products, which were very focused almost exclusively on what's called information capture. So ingesting documents and other information, regardless of how they might arise, whether they're on paper or some electronic form, and ensuring the accuracy and validity of all the content in there, and then passing it down to something such as a loan origination system. But they've now made the decision to actually move all of their applications over time to our more current intelligent automation platform that provides a much more comprehensive solution to not only providing the capture capabilities, but also automating all of the downstream business processes necessary in order to understand, act upon, and collaborate with the submitters or the customers in this case, in order to ensure that they are consistently applying their internal controls, the compliance measures that they have to live with, and also providing a very high level of quality experience to their customers. Now, another example is Diebold Nixdorf. Now, Diebold Nixdorf, believe it or not, is about a 150-year-old company that originally was founded to manufacture safes. Those big metal, thick things that people use to store all sorts of things in, particularly 150 years ago. But over a long period of time, they transitioned from that to becoming one of the world's largest fintech companies by organic growth, as well as multiple large and small acquisitions that had not been fully integrated or rationalized or transformed or brought into alignment with the way in which Diebold Nixdorf needed to conduct business around the world. They have over $4 billion in revenue. About $3 billion of that is the manufacturing, supply, and support of ATMs around the world. They actually manufacture and supply about 50% of those. And in addition to that, they have about $1 billion a year point of sale solution that they provide primarily in Western Europe. So in February of 2018, because of some of these challenges, because of the way in which the company had grown, the board decided they needed to bring a new CEO in, which they did. And he then collaborated with the board to obtain its advice and support to execute a significant transformation of the business. Because a lot of the internal things needed to optimize and effectively manage and run and the business in a profitable manner have been ignored for many, many years. So one of these initiatives was to digitally transform about 100% of its information technology and information systems infrastructure and systems and applications that they use throughout the business at a cost in excess of $100 million, but realizing significantly greater levels of operational efficiencies and cost savings. Now, I don't only serve on the board of Diebold Nixdorf, but I also happen to be the chairman of its technology committee. And we're charged with providing regular oversight of everything that occurs from a technology perspective, and in the effort that they're doing, monitor the budget that's being in place, how they're spending money against that, and how they're progressing against these objectives, and what sort of cost savings are actually being realized. So I think this is yet another example of the way in which boards can operate at the appropriate level of collaboration and oversight in conjunction with the CEO, and in cases where he brings management in, the broader management team, in order to affect and drive these digital transformation efforts. So with that, let me conclude, and I hope you found that informative and useful. I'd be happy to take any questions that might have arisen.
Thanks so much, Reynolds. Speaking of, we have time for just one question. The rest of them we'll take offline and get back to all of you. So Vijay is asking, would it be good to get your perspective on diversity or the lack thereof on the U.S. boards?
Well, that's a good question, and I say that because I think if you look at best practices from some of the firms who often help boards in recruiting new directors, so take Spencer Stuart for an example that has a very robust practice in that area, they would tell you that investors and shareholders rank diversity and inclusion as a very high priority at the board level. And as a result of that, I think particularly over the last 5 to 10 years, we have seen an increasing focus on that. And I think that most modern engaged boards that I talked about, see that that's a very high priority that they need to affect. And the way in which they do that is as longer term directors roll off the board for good reason, they're replacing them with folks that provide the level of diversity and inclusion that's really warranted. And that would include, not only, from a racial perspective, but also from an ethnicity perspective, and also from a male or female perspective. You need to have full, representation from all those constituencies and in order to really drive a board today.
Yeah, perfect. All right. Thanks again, Reynolds. Appreciate your insights.
Thanks for having me today.